Last time, we analyzed Citiz Space Inc., ticker SIDU. Today, we're really digging into quite a fascinating paradox. SIFCO Industries Inc., ticker symbol SIF. Now, this is a company that has recently seen a dramatic stock surge and reported strong quarterly results. Yet its underlying financials, they seem to tell a different, perhaps more cautious story. So, the central question we'll explore is this. Does SIFCO Industries' recent surge in stock price and that reported Q3 earnings recovery truly indicate a sustainable turnaround? Or do its underlying financial fundamentals and frankly persistent negative profitability metrics present a significant cautionary flag for its long-term viability? I'll be framing the discussion around the recent positive momentum and the signs of operational improvement that suggest, a potential new chapter for SIFCO.
And I'll be looking forward to dissecting those broader challenges, because this is a classic case, isn't it, where, market excitement and these headline-grabbing percentages really demand a rigorous look at the foundational health of a company.
Absolutely. So when we examine SIFCO Industries, and remember, this is a company deeply embedded in the highly specialized, very demanding aerospace and energy markets, what immediately stands out is its, genuinely impressive recent market performance. The stock has seen significant gains. And look, these are not minor fluctuations we can just dismiss. Over the last quarter alone, it surged by an astounding 102.74%. Looking at a bit broader, the past half year shows an even more striking 155.17% increase. And year to date, the stock is up a solid 108.74%, closing at $7.40 on September 18th. I mean, these figures represent substantial investor confidence, a clear market re-rating, and news reports from August and September 2025, they further reinforce this positive narrative, with headlines proclaiming a robust Q3 earnings recovery and margin expansion, and highlighting the stock's surge of over 100% in just 3 months. But perhaps most crucially, and this is the number that really jumps out, the earnings per share. Comparing this quarter's performance directly to the previous one showed an astounding 4,605.08% improvement. That's not a typo, it's a dramatic shift. It signals a strong positive inflection point, a significant departure from its previous struggles. So these combined indicators, they suggest a company that is not just treading water, but genuinely turning a corner. They appear to be effectively capitalizing on their niche in critical components, things for aircraft, industrial gas turbine sectors known for high barriers to entry, stringent quality demands, and, typically long contract cycles. This kind of specialized market can see delayed but significant impacts from operational improvements or maybe new contract wins.
Okay, well, I certainly acknowledge that the recent stock performance is indeed notable and has undeniably caught the market's eye. But I approach this from let's say a different angle, suggesting that significant caution is warranted when you really examine SIFCO's underlying financial health. It's easy, isn't it, to get swept up in these impressive percentage gains, but we really must look beneath the surface to understand the full picture. Despite the reported Q3 recovery, a deeper dive into the numbers reveals a less optimistic and arguably more concerning reality. The trailing 12-month, or TTM, earnings per share remains firmly negative at negative $0.12. And you've got a reported total income of negative $0.67 million and a profit margin of negative 0.80%. Now, these aren't just small details. They paint a consistent picture of a company still struggling to generate consistent profit over a longer, more representative period than just, one quarter. In essence, while they might have had a good 3 months, the last year indicates they're still burning cash overall. Furthermore, key profitability ratios like return on assets, ROA, at negative 2.53%, return on equity, ROE, at negative 7.07%, and return on invested capital, ROIC, at negative 1.39%, they all explicitly indicate that the company is just not generating profits efficiently from its asset base or shareholder equity. In simpler terms, they're struggling to turn their resources, whether that's assets or shareholder capital, into actual earnings, which is, a core function of any healthy business. This suggests a fundamental inefficiency that a single positive quarter, however dramatic that percentage is, might not fully address on a systemic level. And, to compound these concerns, sales. Well, sales have been consistently declining. You've got sales year-over-year, TTM, down 17.56%, and sales quarter-over-quarter down a hefty 24.48%. This consistent contraction in revenue raises significant questions about the true sustainability of any recovery against a backdrop of a shrinking top-line performance. It suggests either waning demand, maybe increased competition, or perhaps an inability to secure new business, all of which are pretty fundamental issues.
I appreciate the detailed look at those trailing metrics, but I believe we're seeing an inflection point that warrants a different interpretation. I mean, the significant jump in EPS quarter-over-quarter by over 4,600% and that reported robust Q3 earnings recovery and margin expansion. We shouldn't understate those. These are far more than just minor improvements. They strongly suggest a powerful inflection point, potentially signaling, the successful implementation of operational improvements, maybe significant cost efficiencies, or perhaps a resurgence in demand within its highly specialized markets. Even if prior periods were challenging, and okay, they certainly were, the current trajectory, especially in a specialized sector like aerospace and energy components, could be indicative of internal operational shifts finally beginning to bear significant fruit. Perhaps they've optimized production lines, secured a lucrative new contract, or benefited from a key supply chain adjustment. Something has changed. And the market's reaction, with the stock appreciating over 100% in 3 months, strongly reflects this forward-looking optimism. Investors are clearly interpreting this Q3 performance as a strong signal of a turnaround, right? They're betting on sustained positive momentum rather than dwelling on past struggles. This isn't about ignoring history. It's about recognizing when a new chapter might genuinely be beginning, especially in an industry where individual substantial contracts can take time to impact the financials. But when they do, they can move the needle dramatically. The market often discounts future performance, and that Q3 jump looks like a clear signal of that anticipation.
Look, while I understand the enthusiasm for a single strong quarter, it's just crucial we don't let a dramatic percentage overshadow the broader, more consistent financial trends. My concern is that a huge percentage increase, particularly when you're starting from a negative or a very low base, can often be misleading about the underlying health. Imagine improving from -$1 to -1 cent. That's a massive percentage jump, but you're still not profitable, right?
Fair point.
So while a Q3 recovery is undeniably positive in isolation, the crucial fact remains that the earnings per share for the trailing 12 months, the total income, and all major profitability margins, ROA, ROE, ROIC, they all remain firmly negative for that more encompassing period. This is not just a nuance. It indicates a company still fundamentally struggling to achieve sustained, system-wide profitability across its operations. A single quarter, no matter how strong the percentage gain, doesn't just erase a pattern of inefficiency, particularly in these capital-intensive industries like aerospace manufacturing, where, long lead times and high fixed costs are the norm. Moreover, that persistent decline in sales, both year-over-year at nearly 18% down and quarter-over-quarter nearly 25% down, that further challenges the idea of a comprehensive and sustainable operational turnaround based solely on one quarter's recovery. Without a consistent and growing top line, achieving durable profitability becomes a much more formidable challenge, regardless of a single quarter's cost efficiencies. It signals a potential issue with demand or market share that even the most efficient operations would struggle to overcome long term.
Okay, I see why you emphasize those trailing 12-month figures, but let me give you a different perspective, focusing maybe on valuation and liquidity for a moment. When we look at SIFCO Industries' price to sales, the PS ratio, it stands at a relatively modest 0.55, and its price to book, PB, is 1.28. Now, these metrics suggest that even after its recent rally, the company appears to trade at a comparatively low valuation relative to its total sales and its underlying book value. And this is particularly noteworthy for a company operating in a high-tech manufacturing sector like aerospace, where valuations can often be significantly higher, right, due to specialized expertise, IP, and so on. A PS of 0.55 could indicate the market still sees substantial room for growth, or perhaps undervalues its current asset base. Furthermore, the liquidity ratios, The quick ratio is 1.18, current ratio 1.46. These suggest adequate liquidity. They indicate a reasonable ability to cover its short-term obligations and maintain day-to-day operations without, undue stress. Coupled with a beta of 1.08, which suggests its volatility is only slightly above the broader market average, these metrics taken together, they indicate a company with inherent growth potential that hasn't been excessively priced even after its recent rally. Investors are potentially getting a foundational company in a critical sector at a valuation that still leaves considerable room for appreciation, despite the recent run-up. Maybe the market sees a path to future cash flows that isn't fully reflected in the current historical profitability.
That's a compelling argument regarding valuation. I'll grant you that. But I think we must consider the full picture when it comes to debt and its implications. The enterprise value, the EV, is $68.56 million. Compare that to the market cap of $45.74 million. That immediately implies a notable level of underlying debt that isn't reflected solely in the stock price.
Right, the difference there.
Exactly. That difference. Over $20 million, it's not negligible. And we see this debt clearly reflected in the ratios. Debt equity is 0.69, long-term debt equity is 0.35. Now, for a company that is currently unprofitable on a trailing 12-month basis, and as we've discussed, consistently showing declining sales, this level of debt could become a significant burden. Servicing this debt when revenues are shrinking and profitability is elusive, that can exert immense pressure on cash flow and future investments. It could potentially starve the company of capital needed for growth or even just essential operational maintenance. If that anticipated turnaround doesn't materialize as rapidly or as robustly as perhaps some hope, the debt could quickly become a major drag. And furthermore, we have to acknowledge the stock's inherent volatility. Daily volatility at 5.19%, weekly at 6.11%. This means these valuation metrics, while informative, are subject to rapid and sometimes dramatic shifts. In such an environment, the long-term fundamentals, sustained profitability, consistent sales growth, they become paramount because they provide the stability that can weather market fluctuations. Without them, relying solely on relative valuation multiples can be, a risky proposition, as the valuation can quickly erode if the promised growth or profitability doesn't actually appear.
Okay, beyond these financial ratios, though, we also need to consider the company's governance and ownership structure as key indicators of its long-term health and stability. And the ownership structure of SIFCO Industries, it presents a significant degree of, alignment and commitment. Insiders own a substantial 38.63% of the shares, and institutional investors hold another 18.24%. This high level of insider ownership is often a very positive sign because it strongly aligns the interests of management and key personnel with those of the broader shareholders. It indicates a deep, vested confidence in the company's future from those who are intimately involved in its day-to-day operations and strategic direction. They literally have their skin in the game. Beyond ownership, the company successfully regained compliance with NYSE American listing requirements back in October 2023. Now, this is more than just a procedural detail. It demonstrates a clear commitment to addressing governance and operational standards. For a company that has faced challenges taking concrete steps to ensure regulatory adherence and investor confidence, that points to focused, responsible leadership, which is absolutely critical for a sustainable recovery. Strategic vision and a tangible move towards greater operational stability, reducing that risk of delisting, which can severely impact shareholder value and access to capital.
Well, while insider ownership can certainly be a positive indicator of management's confidence, it also has a flip side, doesn't it? Particularly for a smaller company like SIFCO, operating in a volatile environment. With insiders holding such a significant portion, it implies a relatively small public float. Just 3.79 million shares. This means the number of shares readily available for trading by the general public is quite limited.
True.
And in a volatile market, such a small float can actually exacerbate price movements, magnifying both upward surges and downward declines, as we've already seen with the stock's recent dramatic performance. While it makes for exciting headlines, it doesn't necessarily reflect a fundamental shift in value, but rather potentially just a supply-demand imbalance for a limited number of shares. Regarding compliance,
Okay, it's true they regained it in October 2023, and that is a necessary and welcome step. However, the material also shows a pattern of prior notices of non-compliance with NYSE American listing requirements as recently as August 2023 and February 2023. This history of intermittent non-compliance, it raises legitimate questions about the long-term operational consistency and stability of the company's management and internal controls. It suggests a pattern of, let's say, navigating close to the edge of regulatory standards, rather than consistently operating with a robust buffer. So while regaining compliance is good, a history of repeated non-compliance notifications could point to underlying systemic issues that might resurface, demanding continuous vigilance from investors, and potentially impacting the company's reputation and its ability to secure new, critical contracts in the long run, particularly in sensitive defense and energy sectors.
Okay, so in summary, while SIFCO Industries certainly faces ongoing financial scrutiny and yes, has a history of challenges, the substantial positive movements in its stock price, coupled with that reported strong Q3 earnings recovery and margin expansion, they suggest that significant progress is being made. The sheer magnitude of the quarter-over-quarter EPS improvement, along with, relatively low valuation multiples for its sector and that strong insider ownership, it indicates a company potentially in the midst of a genuine fundamental turnaround. The market appears to be recognizing this potential inflection point in a crucial industrial sector, signaling confidence in its future trajectory and betting on management's ability to execute. This is perhaps a story of potential resurgence, where the recent data points towards a brighter path forward.
My perspective, however, still emphasizes that SIFCO's financial health requires a much more sustained demonstration of profitability and consistent revenue growth before we can declare a definitive turnaround. The persistent negative earnings, the profit margins, the sales declines for the trailing 12 months, they highlight fundamental challenges that, despite a single positive quarter, demand continued rigorous monitoring for long-term viability. The debt levels we discussed and that historical pattern of compliance issues further underscore the need for caution. It suggests that while the immediate future might look promising based on Q3, the company still has significant hurdles to overcome to establish consistent, robust financial health. It's really a reminder that one strong quarter, while exciting, doesn't always erase a deeper, more entrenched financial reality.